Right, 11 o'clock. Morning, everybody, and welcome to the show. So, as usual, I've got some news to run through, and then my guest this week, something slightly different from the ordinary. We're going to be talking to Richard Stone, who's the Chief Executive of the AIC. So, I'm sure you've got plenty of questions for him. If you do, please put them into the YouTube chat box, and I will relay them to Richard. So, news first. Three things that I pulled out, and nothing particularly massive, but I just wanted to talk about Temple Bar first. It's a stock that we've written on, and will continue to do so for a while. And one that I like quite a lot, actually. It's a chunky size, 850 million, trading at relatively narrow discount, which is obviously good news, and a reasonable dividend yield, but we'll come on to that in a second. The results for 2024 are very good, and you can see those there. So the NAV and the share price were well ahead of the all-share benchmark, over sort of 11%. And actually, that's carried on going into 2025, even though the market's changed a bit, and that's quite encouraging. So we've got actually 6%, more than 6% outperformance for the share price over the all-share so far in 2025. And since the Red Bull team took on the trust in October 2020, so we're sort of 4.5 years in. It's returned more than, well, yeah, I think more than double the return on the all share, which is great news. And unsurprisingly, given all of that, when you rank the UK equity income sector by 5-year NAV returns, it comes out on top. Despite that, is that it had sort of struggled a bit in the 6 months before they took stock over. So very good news. I'm sure a lot of people will be quite happy with that. But if you rank it by dividend yield, then it comes out fairly low, so down towards the bottom. And there's a good reason for that. When they took the trust on, or around the same time, the board took the decision to cut the dividend by 25%. Now, obviously, that's not something that you do lightly with the UK Equity Income Trust, because it wrecks your track record for things like the dividend hero stuff. And so it was quite a big decision at the time. But the board felt, and I think new managers agreed, that it was trying too hard. So although that dividend in 2019 was covered, it was a real struggle to get there, and that was affecting the performance. So they wanted to bring the target level of revenue generation down to try and match the expectations of what they could do in terms of total returns. Then in 2020, we had COVID, and obviously that meant a massive great hit to the revenue, which you can see in that pink line there. And so the dividend cut you can see down there, but that was a lot of that came from capital. And the same was true in 2021, still wasn't quite covered. It was covered in 2022, not quite in 2023. But by the time it gets to 2024, the dividend is actually ahead of where it was in 2019 when it was cut. So they have been growing it quite substantially all the way through. And it was covered by earnings. So that's obviously good news. What they've decided to do, and actually I think I really quite like this. So a lot of trusts have said we will pay out an enhanced dividend based on a percentage of net NAV. So there might be a percentage of NAV at the end of the year, it might be a percentage of NAV at the end of the quarter. So 4%, 6%, there's plenty of different examples of this. What Temple Bar are doing instead is they're going to top up the whole dividend by 3p per year, and they're going to do that in quarterly chunks of 0.75. So it's a fixed amount. So you'll get the normal underlying dividend growth plus the top up, which is obviously coming from capital. And so that should mean that even if the NAV goes down, they should be able to keep the dividend progressing, which is obviously, if you're investing for the income, is going to be very good news. And the rationale for doing that makes perfect sense as well. So they're saying, we're seeing a lot of companies opting to buy back stock rather than raise their dividends. And we're not unhappy with that, because it makes perfect sense for them to be buying back their stock while their share price is depressed. We know the UK market is valued too lowly. And so they're very on side with this. And this makes perfect sense. And it makes sense to me too that they're going to do that. So if you wrap all of that up, just topping up what they paid quarterly last year with that extra thing. They've done a percentage yield of about 5%, which will bring them much higher up in that table. So all good news. Harmony Energy Income, less of a good news story. We can see there on the chart with the NAV and the share price peaking back in 2023, and then everything sort of the wheels coming off as they struggled to generate their portfolio wasn't quite finished yet, but when the other battery storage companies said we were struggling to generate revenues in the UK, that obviously affected sentiment, and also we had the general widening of discounts while interest rates were going up. What the board did is say, look, this isn't sustainable. We're going to have to do something about this. And so they basically said, we're going to sell the assets off. And I think there was sort of jury's out type situation. So that the share price moved up a bit, but not a lot, because people weren't sure what the batteries were really worth. And so this bid from Foresight Group is actually quite good news for that. So they're saying 84p a share, which is a decent premium to where the share price was before they announced it. It's a very big premium to where the share price was before Harmony said, okay, we're going to give up. It's still a 9% discount to NAV, but that's reasonably tight. There was a competing deal on the table, and so this is not a done deal yet. Foresight haven't actually made the bid yet. They've just said that they'd like to do it. The board have said if Foresight do press the button, then we are going to recommend it. And actually 12% of the Harmony shares have been committed to voting in favour of this. But talks are still ongoing, so this is not a done deal by any stretch of imagination. But it does mean that it's a mark in the sand, and it could be that somebody comes along and tries to top it, or it could just be that it goes out at that kind of 9% discount. Now, obviously, the read across here is for the other battery storage companies, QuotedData and Gresham, which are still trading on enormous discounts. And the sort of Harmony discount there of about 15 is reflective of the fact the uncertainty that the bid's actually going to definitely materialize, but I think that will just sort of tick up once it does. Given that line in the sand, you'd think that the other two share prices would respond, but I've been saying this in all sorts of situations, all sorts of bids, and it hasn't happened yet. We do have the other potential catalyst for re-rating in Gore Street, in that they are waiting for the tax credit money to come through for their US battery assets. And when that does come through, that should be a big chunk of change, which they can then use to buy back stock if they want to. So we shall see. Lastly, Chelverton, ZDPs are a bit of a forgotten part of the market yet at the moment. We wouldn't mind to see more of these issues in future. Chelverton been using for a long time. They just regularly issue new ones when they're mature. And so the 2025 zero is obviously maturing any minute now, actually end of the month, end of April rather. And so they are going to launch a new one, 15 million shares at £2 a share, initially as a kind of rollover for existing holders, but to the extent that those aren't taken up, then they will be placed for their investors. So issued at £1, mature in January 2031, and redeemed at 151.63. So you just get a nice steady accumulation of value all the way through until the end date. So the redemption yield on that is 7.5%, which is fairly high for borrowing costs. You think if you borrow at the moment, you pay Sonia the sort of like plus a margin. That does seem fairly chunky to me, but nevertheless, obviously the board's happy with that. There's an initial asset cover of 2 times, so that means if you had to pay the redeem them now, you'd have enough assets to cover that twice. And obviously that goes up and down according to what the NAV does in Chelverton UK Dividend. And that's the only kind of threat with these things, that they're normally relatively safe investments, but you have to worry about that NAV volatility. So there we go. The only problem is I don't think it's going to be very easy for retail investors to buy them. A, we don't know how many shares are going to be left over from the rollover. And B, because I think it's structured as a placing, I'm not sure you're going to be able to participate. There is a prospectus out there. If you can work your way through that and see if you can, by all means do so, or it might be that your advisor can do them. And obviously, you will be able to buy them in the secondary market when they start trading, and that's going to be on the 30th of April as the old ones expire. So that's enough news from me.